The Independence Day jobs data week is behind us, and Thursday signed off with another sharper sell off in the US cash session. What the coming trading day and the week have in store is exactly what we'll look at together, as always, in our level of interest market briefing. My name is Oliver Sparring, I'm head of trading at TradeNeon, and I welcome you to today's edition from July 6th, 2026. Summer is in full swing. The famous summer lull begins. Everyone gradually heads off for their well-earned vacation. The markets get quieter and slower, and we all finally, hopefully, have time to catch our breath and digest the volatile past weeks. Maybe a little. In this format, as always, we look together at how our market analysis for the day shapes up, where the interesting price areas are. We put together a trading plan for the day and, of course, also go through the key data points of the week together. So let's get started right away. Here we go after the intro. As always, we start our market outlook with the current economic data of the week. After the shortened jobs week, things get quieter on the data calendar this week, but more Fed heavy in return. Today kicks off right away with the ISM non-manufacturing PMI at 10 a.m. Eastern Time, expected at 54.2 after 54.5, along with the S&P Global Services PMI forecast at 51.3. So the service sector is still growing but losing a bit of momentum. What's really interesting is the ISM prices component, which last came in at 71.3. If that stays high while growth softens, that's exactly the balancing act the Fed can't use right now. The highlight of the week comes on Wednesday at 2 p.m. Eastern Time with the FOMC minutes, which will show us how controversial the discussion behind the scenes really was. Flanked by the 10-year note auction last at 4.538%. On Thursday, we then get the initial job claims expected at 218,000 after 215,000, as well as the 30-year bond auction last at 5.05%. Those two auctions are this week's quiet test of how much appetite the market still has at the long end. On the earnings side, this week is still the calm before the storm. The big Q2 season doesn't really kick off until next week when the banks get going and expectations are high. FactSet is looking for around 22% earnings growth in the S&P 500, which would be the second straight quarter above the 20% mark. Three names are interesting nonetheless, and all three are consumer barometers. Levi Strauss reports on Wednesday after the close with 24 cents of earnings per share expected on $1.52 billion in revenue, a gain of just under 5%, and the stock has recently outperformed the apparel sector by a clear margin. PepsiCo follows on Thursday before the open with an expected $2.21 per share on $24 billion in revenue. Here the market is mainly watching the sluggish US snacks business, where the scanner data haven't shown any recovery so far. Delta Airlines closes things out on Friday before the bell. Revenue is set to rise a solid 13% to $18.9 billion, but earnings per share at $1.47 will land around 30% below the prior year. The deciding factor will be whether premium travel demand keeps carrying the margins. Together, jeans, snacks, and plane tickets give a pretty clean picture of how the US consumer is really doing right now. The dominant driver remains the nervousness around AI and China. The Nasdaq 100 shed 1.6% on Thursday on a daily range of over 3%, while the S&P 500 closed practically unchanged. And it's exactly this split between tech and the broad market that carries us into the new week. On top of that comes geopolitics on two fronts. In the Strait of Hormuz, Iran effectively controls the passage and is offering China special terms. Any escalation there feeds directly through to Brent, WTI, and the energy names, and fittingly, the crude oil inventories are also due on Wednesday. Also on Wednesday, Trump meets Zelensky on the sidelines of the NATO summit, and Trump is signaling readiness for an end of the war. Diplomatic movement in the Ukraine war can noticeably move risk premiums, energy, and defense stocks. On the other side, there's a clear risk-on signal. The investment banking business is booming again. Large mergers and equity issuance are picking up, and a red-hot M&A market doesn't exactly point to a crisis mood. The VIX turn structure confirms that picture. Clear contango, no acute stress priced in. So whether the week stays risk on comes down to whether the tech nerves settle and what the FOMC minutes on Wednesday reveal about the Fed's further course. Now let's jump over to the chart and get an overview of the current day. As you can see, the market here is in a green zone between 7,536 and 7,568 points. Note that we are looking at the ES future here. That is the largest future on the S&P 500. We call this green area the Vanna Bull Zone. We derived this zone from the dealer hedging data of the options markets. Anyone who wants to learn more about this topic of the Vanna Zone, we recently published a detailed video on it here on the channel, so feel free to check it out. In practice, two things are important for us to start with. First, on the basis of Vanna, this zone exerts a tendentially bullish effect on the market, hence the name. Just as important, though, is knowing that gamma dampens volatility in this area. In addition, in the video I just mentioned, we explained and discussed why the edges of these Vanna zones offer us the best locations for possible reversal trade entries. Those of you who trade the Asian session because you live in Singapore, for example, would have seen a spectacular reaction right at the start of the electronics trading session here today at the upper Vanna zone edge, especially since it lines up in confluence with the day's expected move and liquidity in the order book. So, right now we are in a sideways channel bounded by the edges of the bull zone. As long as price stays in this price zone, mean reversion is the best plan. Short trades at the upper level edge, long trades at the lower one. The market will probably only show its true face once it breaks out of the area. A breakout to the downside would be significant because it would simultaneously undercut the two important reference levels of the previous day's VWAP and the previous day's settlement price. In that case, we would assume that the buyers whose average position has been in profit since Thursday would come under pressure. Further liquidations here could lead to price selling off relatively quickly. In that case, I would wait for breakouts through the levels and in turn pullbacks to them in order to find my entries in the short direction. Should the market run down to the previous day's low, we are dealing here with the lower edge of a Vanna Bull Zone from the SPY ETF, additionally supported by the lower expected move band of today. So, a lot of support is to be expected here. If the other case plays out and the market breaks out of the current range to the upside, I would be cautious at first. We immediately get resistance from a strongly bearish acting hedging level at 7,580 points, backed by negative gamma in both the SPX and the SPY. I would only be truly bullishly positioned once the market manages to break the previous day's high coupled with the CME span interval. That, however, would also mean the market has to resort itself, and there will be partly chaotic and unpredictable moves. That's why we always recommend beginners in our trading education to focus on trades within the blue Mart span interval. Based on the context, though, we would of course be clearly long-oriented in this case and would look for buy entries at our levels. At the end of the briefing, as always, the disclaimer that this is of course not investment advice and that the levels are not suited to simply placing some limit orders on them and hoping for the best. With level of interest, we always want to combine the market analysis with statistically sensible and backtested trading entry setups from the order flow in order to implement successful trades over the long run. I wish you a successful trading week. If you have questions, write to us in the comments as always. Leave us a like if you want to learn and find out more about order flow trading and working with level of interest, and feel free to subscribe to the channel. On our homepage TradeNeon.com you'll find more information about the level of interest software. Good trades and see you next time. Take care.